Okay. Hi everybody. Just before we begin, a small introduction. I'm Anurag Goyal this side. I did my charter holder in 2006. I'm also a CA from 2002 batch. Anyway, what we are taking today is corporate finance, but just some kind of overview of what CFA Institute looks at when evaluating you on this subject. This course forms around 8 to 10% of the level 1 examination, and it's pretty easy to score 100% on this one. I bet that. Some rules we should be following is now I understand that we will have many questions before and after the lecture. So what you can probably do is you can always get in touch with me on this email ID. It's anuraggoyal4@gmail.com, and probably if you want to speak, drop in a line before calling up at this number. So I am available for you guys 24/7, if that is what I can say. Anyway, I mean, if there are basic doubts while going through the presentation, where you are stuck and you cannot move forward, just raise your hand and let me know. We'll solve that. But apart from that, if you want to hypothesize a situation or discuss some practical matters, we should do that post the class in interest of time. Okay. Now, corporate finance. Now, what's corporate finance? I mean, and the slides are fine, but in simple layman terms, when a company invests into a project, is the project adding to the shareholder value, or is it generating positive returns? That's what we see in corporate finance. That's it. That's what we are talking about in the whole session on corporate finance. Basically, when you are evaluating 2 or 3 projects or a project, does it make economic sense for the company to go for it? What we'll also cover is there are basically 4 or 5 things we need to cover in corporate finance which CFA Institute looks at. One is capital budgeting, budgeting for the project, whether the project is positive cash flow or not. That's the basic thing we have to do. Cost of capital is again the denominator, the factor which you use for discounting your cash flows, or probably the return that investors expect from the project. Working capital management is another important piece of the whole subject. because in today's economic scenario, this is all the more important, that how are you deploying your working capital. Then we'll talk about financial statement analysis and corporate governance, which is purely theoretical, and we'll not get into much of corporate governance because in case you have doubts you can get in touch, but this is more of how is management accountable to shareholders and vice versa, and this is, I'm sure, you have gone through in earlier courses. Okay. Now, some key principles we have to keep in mind while evaluating any project are that you don't take into account sunk costs. Say if I am undertaking market research for launching a new car, say, okay, now that market research, the amount spent on that market research will never factor into my project analysis, because that is an amount spent already. So that's a sunk cost for me. So no point in factoring that into our analysis. Okay, now opportunity cost is another important thing we have to see, because see, if I don't invest in a project, I can always invest it in some risk-free bond or something, right? So I'm anyways generating, say, in today's market around 6.5 or 7%. So that's an opportunity cost for me. So I'm obviously expecting my returns to be much better than this opportunity cost. Externalities, a very good example is the cannibalization of the product. Like if Maruti launches another small car, it's sure it will eat up the sales of existing products. So there is, to some extent, there is that negative cash flow because of lost sale on the existing product of the company itself. So time value of money, I'm sure guys you understand this much better now. 100 rupees today is not the same as after 1 year or 2 years, right? So we just have to make sure that whenever we are doing analysis at 0 point in time, all the cash flows are either discounted or probably factored in. Now, one thing which has to be always ensured is this is not accounting. What we are talking is purely cash flows. So depreciation is not what you will consider. Obviously your taxes will be deducted. So all your cash flow analysis are after tax basis. Okay. Now we'll just go into various project evaluation techniques before getting into what are the type of projects you can get into. See, like there are independent projects. If there are project A and B which are totally independent, so you can analyze their cash flows separately and see which is more beneficial. Then there are mutually exclusive projects. Then there is a project sequencing and capital allocation, which we'll come back to once we have seen all the methods of evaluating a project. Now first is net present value. Net present value is nothing but basically at time 0 when I am evaluating a project, I take into account all my cash outflows, which are the investments, be it in capex or working capital. Then I do a projection of my cash flows at the end of year 1, what will I get, at the end of year 2, what will I get, right? So those cash flows I'll discount to time 0, which is today, and see whether I am cash flow positive, right? I'll just probably explain this to you in a better manner. Say we are at Jan 1st today, 2011. Okay, let's look at it. I am investing in a project for say $250. This is my project cost. Now this cost can be at various points in time which I will incur, but for sake of simplicity I am assuming that this is happening on Jan 1st. I do a projection that what will be my sales for the year, so I come to 31st December 11. For sake of simplicity we will just take 2 years into account. Then 31st 12. I am expecting a revenue of say $1 lakh, 50,000. My operating cost or variable costs, right? This is my depreciation, interest cost. There is a debt component here. 70% debt, 30% equity. I have a depreciation of 15K. Interest cost around another how much? 175 into 10 is 17, so just take this much. This gives me 20 of pre-tax. Please keep in mind this is pre-tax right now, and as I discussed we will have to take after-tax cash flows because tax is an expense for me. 35, so this is 55,000. I deduct my tax, say this is 30%. $16,500. So we come here at around, this is 40.